But yeah, so now that we got this working here, purpose of this is to go over some basics of options trading, like things that we have to pay attention to, getting sort of surface level familiar with the Greeks, if folks don't know what those are already. And then, a couple other important things like open interest, volume, ways to use options, and then principles of scaling kind of at the end here. And so honestly, when it comes to, so I guess first off is, you know, I there are definitely many people who know more about this than I do. So I am by no means like a financial advisor or like an economist who can give you like the really nitty-gritty granular ins and outs of this. But I can tell you enough for you to be successful at using options as a means to make yourself money. And so with that, let's just jump right in. So the Greeks. The Greeks are a couple of qualities that are intrinsic to the value of an options contract. So there are a few things like what is the price of the underlying stock? What is the strike of the contract that you are interested in? How far away is the expiration date of that contract? How does the price of the contract move as the price of the underlying stock moves and as that expiration date approaches? These are all variables that go into the equation that determines how much an options contract is worth. And you have to be familiar with that so that when you're, when you're really, when you're looking at options chains and you're trying to figure out which strike or which contracts to buy, these are things that you should at least take a glance at. And the Greeks are there's really not many of them, and even though there are 4 or 5, there's really only 1 or 2 that matter. So the first one is delta. Do people know what delta is? Not really. Cool. So delta is the for anyone who's in like math or science or anything, it's a very familiar term, is the triangle. Yeah, so how much does the price of the contract change for every dollar change in the underlying stock's price? So change in the contract's premium for every $1 change in underlying stock price. So you might see that delta on a stock is like 0.2. And what that means is that, so if the stock goes up by $1, the value of the contract will go up by 20 cents. And generally speaking,
Positive 2, 120
for
bucks.
calls, actually not generally speaking, straight up for calls, delta is going to be somewhere between 0 and 1. If delta is 1, then that tells you that for every dollar that the price of the stock goes up, the price of the contract also goes up by $1. And if the delta is 0, then the price of the contract does not change at all if the stock moves. These are just the two extremes. In reality, neither of them really ever happen. But what you need to know about that is that delta increases as a call gets deeper in the money. So if that's exactly right, effects. So the probability of expiring in the money. So if you have a contract that let's say the strike price is $110, but the stock's price is $100, right? Then and it expires today, then that stock has like basically 100% chance of expiring in the money. So the delta on that contract is going to be like infinitely close to 1. Whereas if let's say you bought like Tesla $500 calls that expired today, and it was trading at like $300, then that has like pretty much a 0% chance of expiring, of becoming in the money. So the delta is going to be pretty near zero for that contract. And so as an in the money call approaches its expiration, delta approaches 1. And that's what I mean by that. And contrarily, as an out of the money call approaches expiration, delta approaches 0. Puts are the exact same concepts, but the opposite. Okay, cool. Big vibes. Good question. So when I say in the money, I mean that, so when you buy a call, what you're actually doing is buying the right to buy 100 shares of that stock at that strike price. So that's really good. I'm glad you asked that question because I need to take a step back and really explain this stuff. So let's say, so we bought earlier this week, we bought HIMS 59, I think it was 55 calls. So what we were doing when we bought that was we bought a contract that said, by the 9th of May, we have the right to buy 100 shares of HIMS for $55. And somebody, it could have easily been me, it could have easily been you, like sold that contract. And so somebody has 100 shares of HIMS and they are selling this contract to whoever will buy it. You buy the contract, and then you have an agreement with the seller of the contract that you will buy 100 shares of HIMS by May 9th for $55. And so if HIMS goes up to $56, then your contract is in the money, and that's good for you, right? Because in theory, if you exercise that contract, if you actually execute it, then you buy 100 shares of HIMS from that person for $55, and you can immediately turn around and sell them for $56. So you made $1 per share through that contract. So when I say it's in the money, for a call, I'm saying that the current price of the stock is higher than the strike price of the option. For a put, it's the same concept, but literally the opposite. You are entering a contractual agreement to sell somebody 100 shares at whatever price. And so if you thought HIMS was going to go down and you had a put for $55 and HIMS plummeted down to $45, then your put, that's a bad example actually. So if you had a $40 put and HIMS was $45, then your put is in the money because there's $5 between the price of HIMS and the strike of the contract. I feel like that got a little confusing. Are you with me on that? Okay, cool. And so what is in theory supposed to happen is you buy this contract, the price moves, it goes in the money, and then you execute the contract. That's the way it's sort of like supposed to work. What happens in real life a lot of the time is that, like 100 shares of HIMS is going to be, 100 times 50, which is $5,000, right? Yeah, $5,000. And so if you don't have that kind of money in your account, then you're just going to buy the contract when its value is low, and you're just going to sell the contract later when it's high. But there are lots of people who have larger accounts who are actually executing these contracts and actually selling or buying shares after the stock price has moved. And I'm going to talk about that more at the end. However, so that's like what an option is. It's a call is a right to buy 100 shares of the underlying stock at that price, and a put is an agreement to sell 100 shares of the stock at that price. And so if you're buying a call for $55, you want the stock to go above $55 or at least close to it. Whereas for a put, you want the price to go below the strike price. And so, if HIMS is trading at $50 in the morning, and this was, I think it was the day before on the 7th, but like if you had bought a $55 call here when it was trading at $51, and then you sold that $55 call up here, even though it wasn't at $55 yet, that contract was worth a whole lot more because the delta is increasing on the stock. The stock has moved up in price, so the options contract has gone up in price and it has gained value. So you can just turn around and sell that contract back to somebody else. And so delta, coming back to the Greeks here. Yes, SVZ, you would need high collateral in order to exercise. And that's why a lot of people who are trading options without any intention to ever exercise. They're literally just playing the game. They're just like riding the wave as the contract's value changes over time. And so delta is the change in the contract's premium for every dollar change in the underlying stock's price. For calls, that ranges from 0 to 1. As your call gets in the money, the delta is going to approach 1, and so for every dollar that the stock goes up, your contract is going to go up for somewhere near $1. And the opposite is true for puts. So puts range, delta ranges from -1 to 0, and delta decreases as a put gets deeper in the money. An in the money put approaches 1 as expiration approaches, and an out of the money put, delta approaches 0 as expiration approaches. So delta is the first and honestly one of the only two Greeks that I really pay attention to the most. And KO, thank you again. And I love that you guys are typing this stuff here, because if I'm sort of lost in my my brain and forgetting to really say fundamental basic stuff, I really appreciate you pointing that out. So that's what delta is. So you're buying a call if you think the price of a stock is going to go up, if you are bullish on that stock, and you're buying a put if you think the price of a stock is going to go down. So you're using the system. In my case, it's my EMAs and my Fibonacci levels. If I see that the momentum on a stock looks like it's going up, I'm buying calls on that stock. And conversely, if it looks like the price of a stock is about to go down, then I'm buying puts. So that's delta. Gamma is the next one, which is the easy way to think about it is it's the derivative of delta. So it is the rate at which delta changes. Think of it as if delta is speed, then gamma is the acceleration. The more official sort of definition of gamma is the rate at which delta changes per dollar of underlying stock price movement. So coming back to that example, so if delta is 0.2, you might have a gamma of 0.1. So let's say that your stock is worth, the stock is $50. Price goes up by $1 to 51 bucks. Your contract has increased in value by 20 cents. And the new delta on that contract is 0.3. Does that make sense? Because now, it has accelerated, right, in the upward direction. And so the delta is now greater than it was before. What time frame is used for the derivative? It's based, yeah, so it's just like the rate at which the delta is changing. So as, so if the price goes up by $2, then now your delta is going to be 0.4 because that gamma has taken effect for $2 now instead of 1. So as contracts, or as if you have a call on a stock and it goes up, 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 the rate at which its value goes up kind of compounds for you. And so there's really not anything more to gamma than that. I guess the last thing to kind of say is that as an option goes further in the money, gamma does decrease to 0. Because if you think about it, if you get delta up to 1, right? So the contract is going up by $1 every time the stock goes up by $1. There's no world where the contract gains value faster than the stock does, right? It's like light speed. You cannot go faster than that. And so once you hit the max speed of your car, you can't accelerate anymore, and so your acceleration goes to 0. So once your option is heavily in the money, gamma's pretty much 0. Gamma, I sort of half pay attention to. The next Greek, which is theta, this is the other one that really matters. Theta is how much the price of the contract decreases per day. This is time decay. This one is so important. And this one we talk about all the time, especially with day trading, because a lot of the times we're playing with contracts on the indices that have daily contracts. Like SPY has contracts that expire every single day of the week. But most individual tickers have weeklies that expire on Friday. And so, like if we're playing 0 DTE, like 0 day to expiration options, theta is our enemy, because if you can imagine, part of the value of a contract is the time that remains until it expires. So for example, I am in these June 525 puts because I think SPY is going to go down between now and June. And part of the value of that contract is that SPY has like a month to move between now and when my contract expires, right? Whereas if I had a 525 put that expired today, there's not a whole lot of, there's like 0 time for SPY to make that move. So the contract is inherently less valuable because of that. So theta is the extent to which a contract's value is defined by time that remains between today and when the contract expires. The important thing to know about that is that the time decay is not linear. It is not linear. So the rate at which theta impacts your options price is not a straight line like a 0 or a first order kinetic kind of thing. As the expiration date approaches, theta decays more and more rapidly. And so what I mean by that is like, for example, for the June puts, right? We have a month between now and when those expire. So like day to day, the time decay does not matter. But there are there's one or two sort of timelines where time decay becomes really important to pay attention to. 10 days prior to expiration, theta decay gets pretty rampant. So the theta on your contract is going to become very impactful during those last 10 days. So like, for example, if theta is 0.1, then each day that passes your contract loses that much in value. So if you paid $1 for a call on Wednesday and you did not sell it Wednesday and you held it until Thursday, if the price does not change at all, if the price is the exact same tomorrow at open as it was today at close, that contract is worth 10 cents less per share. And so that's significant because if we buy a weekly contract on Monday that expires Friday, we know we have a little bit of time. But if we buy a contract that expires Friday on Thursday, we should probably sell it Thursday unless we're super duper confident it's going to go in the money on Friday. So on the final 10 days, the time value erodes very, very quickly. The other important thing to know is that theta decay still happens on weekends. So you think that, oh, Saturday and Sunday are here. These aren't trading days. None of the Greeks matter, but you would be wrong in thinking that. Theta decay is still happening on Saturday and Sunday. So if you bought like Monday or even if you bought weeklies for next week today, they're going to be worth less on Monday if the stock price did not go in your direction. Yeah. And we're going to talk about the interplay of theta and delta as soon as we're done talking about these Greeks. And there's not a whole lot more in this regard. When you're trading zero DTEs, theta becomes a big factor, right? Because at 4 p.m. on the day of expiration, if that contract is not in the money, it is worthless, right? Because why would you exercise a contract to buy HIMS at $55 if HIMS is currently at $51, right? So if HIMS is 51, 52, 53, 54, even if HIMS is $54.5, your $55 call is worthless as of 4 p.m. on the date of expiration. So theta, if you're holding a call that you bought on Monday that expires Friday and you're still holding it Friday and it's not in the money, theta has murdered the value of your contract. And that's really it as far as theta goes. When I'm done kind of going through, actually, yeah, I have this here. This is a good sort of graphic that goes over what I'm saying, where, as days to expiration, as we get to the day of expiration, you can see that the value of that contract exponentially declines if it's not like in the money. Okay, so I'm gonna get rid of that. But Vega is the other one that sort of matters. Actually, it matters a lot. Theta is basically IV, which is implied volatility, which is general speculation as to like how much does the contract's value change per change in IV. IV is speculative, and IV implied volatility is higher when people think that a dramatic move in the stock's price is coming. And what kind of things make us think that a dramatic move is coming, right? Earnings. So immediately before earnings, the IV on most stocks is going to be much higher than it is at some other time because people are saying, oh, there's these estimates, they're going to release their earnings, and it's either going to beat estimates or it's going to be less than estimates, and the market's going to react. People are either going to buy a lot or sell a lot, and people know that immediately before earnings, the implied volatility is going to be very high. Similarly, on the indices, right, like SPY, QQQ, these things, ER goes up before economic numbers are released or major news happens, right? So like if we know that FOMC is happening at 1 p.m., then the morning of FOMC, IV is going to be sky high for most indices because people are anticipating major moves later in the day. And this matters because the IV is high before something like earnings, right? But then let's say that the earnings for your stock happens at 5 p.m. after hours on whatever day. Then the IV is high before market close that day. The earnings report happens after hours. The stock goes bonkers one way or the other. And then the next day, the move has happened already, right? So the day after earnings, IV plummets, right? Because the move has already happened. People don't think something crazy is going to happen already, right? Yeah, news like splits mergers can affect that too, right? If there's like a rumor that like, I don't know, Johnson and Johnson is buying out some little biotech company, then the IV, the Vega on contracts for that small company is going to go through the roof because that rumor is there. And then when the news comes out, you know, um, the stock moves and the Vega goes down because Vega was only high because people were anticipating a crazy move. And that same thing happens with earnings all the time, dudes, all the time. And this is so key because post earnings, volatility drops dramatically. The move already happened, like I just said. What happens there is sometimes the drop in IV outweighs the delta of a contract, right? So let's say Microsoft has its earnings, and people are anticipating some kind of crazy move on the Microsoft price as a result of the earnings. So IV is really high. People are buying contracts that are like, maybe a few bucks out of the money. And then Microsoft has a good earnings report, but the price doesn't move that much. It moves a few dollars, right? Let's say it goes up $5 and your contract is in the money. However, the IV, the Vega, has gone away. And this happens a lot where, Delta worked in your favor, your call is in the money now, but all of the volatility went away. And so the value of the contract went way down. And so if you ever have held an option through earnings, you might have seen this happen where your contract was out of the money before earnings. The price, like let's say you had a call and the price of the stock went up, and now your contract is in the money, but somehow it's worth less and you've lost money and you're frustrated, you're like shitting your pants and you're crying, saying like, but I was right. It went in the money. Why did this happen? And it's because all of the volatility went away. Vega did not work in your favor. So this is why when I say I rarely ever hold contracts through earnings, this is why. Because unless the move is really crazy, like TMDX, right? That stock went up 20% after the earnings. That's a crazy move. So IV went away, but the delta was humongous. So that would have been a contract that worked out. Whereas, if it had only gone up by like $1 or two, Vega would have murdered my contracts. So this is a very important thing to pay attention to as well. I'm going to answer a couple of these questions here. What are the ideal delta and theta values? There's no one specific answer to that question. You are always just assessing both of those things in conjunction with, like, are you day trading this? Are you swinging this? Are you swinging this overnight, or are you swinging this for a week? How far do you see the stock moving in that period of time based on both your fundamental analysis and your charting? So there's not a perfect answer to that question. It is not one size fits all. How long after a volatility increasing event can the IV stay elevated? That's also it completely depends on what the event is. Whoa. It completely depends on what the event is and how impactful it is. For an earnings report, IV is going to drop immediately. Um, you know, sometimes that's not always the case 100% of the time, but in the vast majority of cases, IV is much higher pre-earnings than it is post-earnings. And so that's why you really have to have, you really have to have either balls of steel or confidence for some reason that the stock will move dramatically in the direction you've predicted after the earnings. You really have to be super confident in that to hold through an earnings report. Basically, these are the only Greeks that matter, I would say. There is another one. It's called rho. It's like how much the option price changes with interest rates, but like that sort of doesn't matter at all. It maybe affects like 0.5% of a contract's price. Don't quote me on that, but I literally ignore rho, and you can too. And so that's the Greeks. Um, that's just the basic concept of the Greeks. So what I want to talk about now, actually what I'm going to talk about first is open interest and volume, and then I'm going to talk about choosing a certain expiration and a certain strike, and what goes into those decisions. So open interest is literally how many contracts are there, which I guess the first thing we need to talk about is who is writing these contracts, right? The answer is fucking anybody. Like you can write these contracts. I can write these contracts. What you have to have some kind of collateral though for that contract. So let's say you're selling a call on a stock, right? So if you're selling a call, you think that the price is going to go down. Actually, this is some advanced stuff. I'm going to hold on that. That's for another day. The point is, anybody can sell a contract. And so when you look at the open interest on a specific option, you're looking at literally how many contracts are out there. And on volume, you're looking at how many of those contracts have been traded today. This volume refers to this trading session. So this isn't for all time. This is literally just today. When you're looking at this, like what do you do with that information? Open interest is basically the liquidity. So if you can imagine, if a contract has like an open interest of 10, then in the entirety of the stock exchange, there are only 10 of that call in existence. There's not a lot of people trying to trade that. There's not a lot of people who have written those contracts, who have bought those contracts. That is not a very liquid contract. And that matters, right? Because you go to click sell, somebody has to buy it. But if the interest isn't there, like nobody cares about that contract, no one's going to buy it and you're never going to sell it. So you need to pay attention to open interest. Similarly, volume tells you, okay, so there's 15,000 of these contracts for HIMS, and today 9,000 of them have exchanged hands, right? So it doesn't matter if there's 15,000 contracts out there if nobody's playing with them, right? So if the volume was 10, it doesn't matter that the open interest is 15,000. You're going to have a hard time selling that contract if you own it, right? And so you need to pay attention to these numbers. So when I say, like earlier today, was it today? Yeah. I said I was looking at options on Okta, right? You know what? I'm just going to pull the Okta chart up. All right. So I said that I was looking at Okta. I'm just going to eeny, meeny, miny, mo. I'm going to pick this day. That I was looking at contracts for Okta to buy for later this year, but that I wasn't going to tell you guys what contract I was buying because when there's not a lot of liquidity, like look, this contract, there are 6 of this contract in existence of the June 13th 122 calls. There are only 6 calls out there and none of them traded today. So if I told you, oh, I'm buying the June 13th 122 calls for Okta, then you guys would try to buy all those up and you would become my liquidity. Like, who are you buying those 6 contracts from? You're buying them from me. I'm selling to you. So you would be my product. And that would be kind of fucked up of me. So that's why I wasn't telling you guys what contracts I was buying, right? And that is a gullible move. And I've talked about this before. I don't think we're gonna have time for it, but I can do a separate thing about this maybe another time. But when options are illiquid, when there's not a lot of open interest or not a lot of volume on there, and you see some kind of guru call them out, and then you buy it, you chase it, the price goes up, and you buy it at a higher price than that guru called it out at. The answer is who did you buy from? You bought from that guru. That guy turned you into the product. So you need to pay attention. Whoa. You need to pay attention to the open interest and the volume. Okay, cool. So then the last thing that we'll talk about is choosing an expiration and a strike price. So we're done with the Word document here. When I'm choosing an expiration, I am literally saying to myself, how long do I plan to hold this contract? Geez, this screen is a mess. Like, how long do I plan to hold this contract? Is this a contract that I'm gonna hold for a day? Then I might buy a 0 DTE contract. If a 0 DTE isn't available, I would buy the next closest one, which might be a weekly. If this is a swing position and I'm planning to hold it for like a week maybe, then I might buy a contract that expires in a week or in 2 or 3 weeks, just as a way to give myself a little bit of padding just in case. What sort of goes into that decision? Why is this doing this? Oh my God. What sort of goes into that decision is an amount of, confidence in the play, right? So let's say we're talking about hymns here, right? Hymns we played on Wednesday. I'm just going to pull up the 10-minute chart here. Yeah. On Wednesday, I was pretty confident that this stock was going to go up. The closest expiration option on hymns, because hymns doesn't have dailies, was weeklies. So I picked the weeklies. If I was less confident that the move was going to happen like that day or that week, I would have bought calls that expire next week, right? So that would have given me more padding. However, so the $55 calls that expire this week are cheaper than the $55 calls that expire next week because of Theta. Okay, so that's where one of those Greeks becomes important. So if you think the move is going to happen like now, then you want to buy a short expiration contract. Why did I pick $55? So that's what goes into the decision for expiration. Is that part clear? Do I need to talk about that more? You tell me, guys. Okay, cool. And so the other thing that I want to make sure is clear is that, so if you see me say I'm buying SPY weeklies or I'm buying HIMS weeklies, you can intuitively know that that call out is a day trade or maybe an overnight or two, right? But, and I saw this a lot in the chat, and we need to talk about this, guys. If you see me post, I'm buying June SPY puts, that's sort of on you guys. You have to know that that is clearly not a day trade, right? That is just so clearly a swing because it expires a month from now. I'm not planning to buy and then sell that within the day. And so that's one of those things that as you're seeing me, TT, and other people call out plays, you sort of have to have the ability to infer the timeline on that trade based on the expiration we chose. So if it's a daily, it is obviously a day trade. If it's a weekly, it's probably a day trade. Maybe I'll hold it overnight. And in most cases, I will specify that. But if I'm buying a put that expires in a month, you should reflexively know that that is not a day trade. Cool. For dailies, does having a higher target price lead to really high theta decay? So I'm going to say yes. So how do I explain this? So at the money options have the highest theta. But coming back to delta though, if your call is a few bucks out of the money, but then it becomes in the money with not a lot of time left, then that delta is gonna dramatically outweigh the change in the theta decay. So that's where lottos come into play. If you buy like a call on Tesla that expires today, that is like at 3 p.m. Let's say you buy what was the one that we bought today that went south? I'm trying to remember. In the DGen chat, it was Tesla calls for 305. That's what it was. So if you buy those, and they're out of the money, right? Theta is murdering you. Your contract is losing value aggressively because of the theta decay. But if Tesla had gone up to $305 in that last hour of the trading day, delta would have made such a huge difference to the value of the contract that the theta decay would have been blown out of the water. So, when we say lottos, we are referring to contracts that expire like at the end of the day, that are out of the money, because they can have like wicked price swings, like literally, SPY calls at the end of a day or at the end of a week, especially, and we could talk about this another time, but on a triple witching day, if you have like a SPY call that's out of the money that expires that day, it might be worth like 2 cents, you know? Um, but if SPY has a crazy move in the last 10 minutes or the last hour of the day and your call goes in the money, that 2 cent contract can become worth like a buck. And so delta and theta can have complex interactions, but cause really wild swings in option prices when we get really close to their expiration. Cool. So that's what goes into deciding an expiration date. And then I think hold on just a second here. When it comes to picking a strike price, that's a very individualized question. And that's based on your trading system. So like, it was this day, it was the 7th, it was Wednesday, that I bought those $55 calls on HIMS, right? Let's just bring this one up here. Yeah, so, and that was because I saw that HIMS was breaking above this Fibonacci level here on the daily, right? And it was a Fibonacci level on both my long-term fibs and my local fibs. So I knew that this 48.5 level was a really significant one. And my next target is the next fib, which is 54.29. So I just picked 55. 54 would have been reasonable too. But I just picked a contract that was near that level that I anticipated would be the next point of resistance. And so that's why I picked 55. That is literally it. That is as simple as the strike price goes. You try to say, where do I think it's going to go? And you pick it. If you're playing a daily or like a weekly contract, you want to pick a strike price that you're confident it will truly reach, right? Like, if I bought, like for example, those Tesla calls, I picked 305, saying it needs to hit 305. And that's different from, like, for example, with these SPY 525 puts, right? If it goes halfway down to 525, but has gained enough value because it's a month away, I'm just going to exit, right? I'm just going to take that money. But for short expiration contracts that are going to expire and lose and undergo theta decay, I'm picking a strike price that I'm very confident it will reach. And in fact, you can see the next day here, it hit my Fibonacci level and it rejected it. So this was I correctly identified the level that it would go to here. And so if you had done a 54, that would have been fine too. Whoa. Okay. So, how do I feel about leaps? That's a conversation for another day. I really intended for this to be like basics of options, but there are a lot of more complicated ways that you can use options to your benefit. Leaps is one of them. Actually executing contracts is another one of them. You can sell contracts. You can do spreads, condor. There's like a lot more complex ways to use options. But for the purpose of like literally learning like what an option is, Greeks, open interest volume, all that stuff, I'm not gonna talk about that today. It's a good question. Yeah, and so I think the last thing that I just wanted to take a moment to talk about, because it's 6:55 and we're gonna run out of time here, is the concept of scaling, right? So this is such an important thing, guys, especially for people who have small accounts, right? Scaling in means, so if I ultimately plan to have 10 contracts, right? Then option A is I buy 10 contracts right off the bat. But option B is maybe I buy 3 or 4 contracts and I make sure that my thesis is correct. I'm like, okay, I think this price is going to go up, so I'm going to buy 3 contracts here. It might go down a little bit though, and if it does, I'm going to buy 3 more, right? So then you have 6 contracts. And then it goes down to your support, and then it bounces back up, and you're like, okay, cool, I was correct. I think it's going to go up. It pulled back to support, and now it's going back up. I'm going to buy the last 4 contracts. So now I have 10 contracts, but I scaled in slowly. So I didn't immediately size in fully, which has 2 benefits to it. One, it mitigates your risk, right? And 2, it allows you to actually get a better price, like average price, on your option. And a perfect example of what I'm talking about was the hymns play from Wednesday. So what was my thesis as I called that out? And I mentioned this in my channel here, but on Tuesday, hymns went up to here. It went up to 50.4. 50.5 was like the high of the day, right? And I saw it do this. I saw it do this. I saw it reclaim my 3450 cloud here. And I saw it, this candle right here, this 10-minute candle, I saw it breaking above that high from the day before. It broke above 50, it broke above 50.5 right here. And so I was like, okay, this is going to go up. I'm going to scale into these calls now, because very often when stocks, break the high of the day before, they keep going. And so I scaled in. To use that prior example I made, I bought 3 contracts here. But I know that my system relies on these clouds, right? The 512 to 3450. So I bought my 3 contracts here, and then it pulled back. It pulled back to the support that I knew it could, right, which was my clouds. It pulled back, and then it bounced back up. So when it found support here in the 512 cloud and it did not fail and continue downward, I scaled in more here and I called this out, right? So I saw the high of day break, I took my entry, I saw it pull back to my pre-identified support, I scaled in more, and then it gave us the move. So if you had full ported right here, you would have been sweating your balls off as this thing pulled back because you didn't scale in. You just bought it right off the bat of a full position size. And you need to resist the urge to do that. The reason, and so you might ask me, why didn't you wait for this pullback to begin with? The answer is, I don't have a crystal ball, dudes. I don't know if it's just going to break above the high and rocket away, or if it's going to test the high, pull back, and then rocket away. So by scaling in, you have your exposure to the move in case it goes right away. But in case it pulls back and takes a little bit of time to make that move, you can also add in more and you can feel okay with it because your initial position was sort of small. So even if it's red, it's not like that red. Your account isn't getting burned. Um, and you can kind of scale into it. And as the price goes down, you buy a little bit more, and then the price goes up, and you have gained more than you would have had you initially ported here. Because if you bought this at like $1, it went back down to 75 cents, and then now up here it's worth $1.50, right? This person has gained 50% who bought it all right here. They bought it at $1, they sold it at $1.50. They have gained 50%. But the person who scaled in a little bit here, scaled in a little bit here at 75 cents, and then sold at 150, they came closer to doubling their money. So scaling in is something you have to get used to doing. And I recognize that, like, look, when you have a small account, let's say your account is $1,000 and this contract is, $500 or is $100, right? You can only buy at a maximum 10 contracts. And it feels sometimes lame to only have one contract and then to make like $10 off of it when you're like, if I had full ported, I would have made $100. But this is a habit you need to develop when your account is small. Because if you develop bad habits when your account is small, your account will never get big, my friends. This is the truth bomb you need to hear. If you just full port stuff and you develop these bad habits when your account is small, you're never going to join the big account club, and that is the hard truth. Develop these good habits. Scale in, accept small wins. Similarly, scale out. And when your account gets bigger, then the moves become more meaningful, right? I said 10 contracts, but let's say you had 100 contracts, right? Then that move would have been a couple grand for you instead of 10, $20 or a couple $100. And that's just how this goes. And so when I say scaling out, I say like, I think this is going to hit $55. So like, I saw it go up here. I saw this kind of doji candle. I said, it looks a little tired. I'm going to take half of my gains here. And then look, I was correct. It came back down. And then it went right. It followed my clouds, went right back up. And I exited it here at this time. I said, this is enough gain. This is fine. I'm just leaving it. And I sold the rest of my contracts here. So just like you can scale into a position, you can scale out of a position too. And that's just a habit that you need to develop.